Hi guys, Max here, and this is your daily market update for yesterday, the 17th of May. Of course, I'm in my new studio, but I'm facing the opposite direction, so things look a little bit different. But really, this is just going to be a normal video talking about what happened yesterday in the markets. So, what did happen? Well, first of all, equities went up for the most part, which was a little bit surprising to a lot of people. As you can see, stocks really were just up across the board. Big tech especially did really well. Amazon and Tesla there rising 5 and 4% each. Apple and Microsoft both up around 2% each. Financials did well, healthcare did well, industrials did well, real estate did okay, and energy did decently too because, well, oil prices rose, but we'll talk about it in a moment. The only thing that really did quite poor was consumer defensives. You see there, Walmart falling by 11% on quite a poor report, and the rest of that sort of sector of companies supposed to do well in the recession, well, they didn't perform too well because risk on assets were doing well, not risk off. Now, what exactly happened with the indexes? Well, the S&P 500 rose by 2% by the end of the day. As you can see, just green everywhere. And as big tech did well too, the Nasdaq 100 rose by 2.75% by the end of the day too. Old world industries and sectors doing a little bit less well, but still rising on the whole, with the Dow Jones rising by 1.3%. Now, across the rest of the world, again, it was a risk-on kind of day, with equities rising for the most part. The FTSE 100 rose by 0.8%, the Stoxx 600 was up by 1.2%, and the Nikkei was up by 0.9%, meaning that across the entire world together, the MSCI World Index rose by 2% for the day, green all over the place, as you can see. Now, just why did equities do really well? Well, there wasn't actually any specific reason. It was just one of those general rotations into risk on assets as investor sentiment changes. There wasn't really any one singular trigger. And because of that, it means that it's quite likely that these gains are not really going to be here to stay. If you look at the trend over the first half of 2022 so far, it's distinctly downwards, and I don't see that turning around at all now that we've had one day of 2% green. Now, regarding currencies, we actually have seen a few days of a relatively minor shift of the US dollar, not strengthening anymore and actually falling a little bit. The spot index fell by 0.7%, the dollar that is. The euro rose by 1.1% and it now sits at just above $1.05 each. And the pound rose by a similar amount and now sits at around $1.25 each. So those currencies are a little bit further away from parity. As that happened, we saw bond yields all over the world actually rise by quite a large amount, with quite volatile moves of 10 basis points and upwards. The US 10-year Treasury yield rose by 10 basis points itself and is now sitting, the 10-year that is, at 2.98%, really close to that 3% mark. We saw similar moves in Germany and Britain, with their 10-year yields rising by 11 and 15 basis points each. Now, I've had quite a few people ask me why I still think yields are going to continue to rise, at least in the short term. And the simple fact is that the Federal Reserve is selling $45 billion worth of bonds every month. And while that isn't a huge amount in comparison to their balance sheet as a whole, I think it will take them about 9 years to sell off the entirety of their balance sheet at that rate. That is still an awful lot of selling pressure that can't be ignored, and I don't think can be counteracted by small-time investors either. Now, regarding oil prices, as I mentioned earlier, they did rise by about 2% for the most part. WTI crude oil is up to $112 a barrel right now, and Brent crude is sitting at $113. Finally, for our traditional financial markets, what happened to the price of gold yesterday? Well, it stayed pretty constant, but just lost a tiny amount of value, and it now sits at $1,820 an ounce, which leads us on to crypto. And what happened over there? Well, things really weren't too great. As you can see, it was red for the most part. Bitcoin is sitting at just under $30,000. Ethereum is sitting just above $2,000. Both of them far, far away from where they were just a couple of weeks ago, where they were above 40K. The entire market then followed in this trend and fell, but not by huge amounts for the day itself. 2%, 3% seem to be the name of the game, as you can see. The bits of green that you do see around are mostly stablecoins, so they're not even too relevant. USDC, USDT, DAI, and BUSD, all stablecoins, and the biggest bits of green you can see there. So actually, there wasn't much upwards movement at all. It was then quite clearly a bad day for crypto when it was a good day for tech stocks. And that's quite unusual because usually we see crypto act as a risk on correlated asset. And this seems to be the polar opposite of that. So why was crypto down then while tech stocks were up? Well, there wasn't just one thing, but there are a few things that could be at play and could have caused this shift. Now, the first is about stablecoins and the risk that they're not too stable. Again, though this time not talking about UST, but about USDT or Tether. As you can see from this tweet here by Crypto Whale on Twitter, well, Tether has been losing a lot of value. They've had a lot of redemptions recently, amounting to about 10% of the entire market cap of that coin. Now, this has actually been rather worrying to a lot of people, and that may have been why the crypto market is falling. And it's also reaching mainstream media outlets, with CNBC coming out and talking about this too. As you can see, CNBC is jumping head on first into this whole stablecoins that aren't so stable narrative, and they're pushing this same idea that Tether probably isn't backed, and as it isn't backed, it could be a major catalyst for a massive crypto market rout. Now, in reality, despite the fact that yes, $7 billion has just been redeemed from Tether over the course of just a couple of days, and that does amount to about 10% of the market cap of the coin, there isn't actually a problem yet, though there is entirely possible that it becomes a problem very shortly. Basically, what's going on is we know that Tether is not fully backed by US dollars. It's probably backed by Chinese junk bonds that are worth a fraction of what they used to be when Tether bought into the market. As a result, at the moment, when you have one USDT and you go over to Tether and you ask them to give them $1 in return for your coin, they can do that, and they are doing that, which is what's happening, and that's why their market cap is falling. The problem is, though, there will come a point where Tether does not have $1 to give you, and when that happens, a bank run will occur on the organization and this token, and its price will probably collapse. Just last week, we saw its market value of USDT, which again is supposed to stay pegged to $1. It's always supposed to be worth $1. It dropped to about 95 cents as there was a lot of fear that that was happening right then. And then things sort of stabilized, but these fears are emerging once more. Now, this is bad for the crypto market. If Tether does collapse, a huge source of liquidity for the entire crypto market will disappear almost instantly, and you can be damn sure that we would see a massive market rout. So investors are getting a little bit worried. Another problem that we're seeing regarding the crypto market is, again, of course, Luna and UST. Now, the fear surrounding this is far, far diminished compared to what it was when it was actually collapsing. But investors still aren't exactly happy or pleased with what's happened and how things have emerged. Just yesterday, Luna's legal team has resigned, which is not a good sign at all, as I'm sure you can understand. Do Kwon came out with a rescue plan to try and get the coin back up to its former glory as well, and that was rejected. There is a lot of attention towards Luna in the crypto space right now, and almost all of it is negative. The reality is that, in my opinion, the crypto bear market is here. It's already started. That much should be obvious. We are 50% or more off all-time highs for almost every coin. And the chances are that actually we're heading into a crypto winter as the rest of our economy and financial markets start to fall apart too, as the macro environment is just so poor right now. Now, another big problem, a big story that I've seen a lot of people talking about over the last couple of days especially, is inflation, but actually not inflation in the US, but over where I live in the UK. Now, we have had a lot of very high inflation over recent months of up to and including 5 or 6%, but for the most part, we were seeing less inflation than the US, and as was the rest of Europe. Things all changed, though, a couple of months ago when the war in Ukraine kicked off. Of course, the UK and Europe especially is hugely dependent on energy sources that come from Russia. And as we're not exactly on good terms with that country at the moment, there are many, many supply issues. And prices have soared sky high, leading to record high inflation for us. And we just got fresh data out of the UK yesterday, and inflation has hit 9%, which is a 40-year high. Now, again, this is largely due to the war in Ukraine, but that doesn't mean it's going to have any less of an impact of the people in this country. If you think that gas prices are expensive in the US right now, well, they're about 5 times as expensive over in the UK. People are being squeezed, and we're having what we're calling a cost of living crisis that is having a huge impact on our politics as well. Now, lots of people are sat here blaming Brexit, and you may see a lot of people talking about Brexit in relation to inflation in the UK, but in reality, it's really not a factor much at all. It may have some tiny amount of impact, maybe 5% or so, but in reality, we're seeing the exact same trend in the UK that the rest of Europe is seeing and the US as well. This tweet here by an economist here in the UK called Julian Jessup does a brilliant job of explaining that. As you can see, yes, the UK is having very high inflation, but it's just as high elsewhere in the continent and across the pond as well. And actually, the EU hasn't had their most up-to-date figures yet, and we should fully expect them to have a jump this month as well, just like we did last month. Of course, this doesn't stop many news articles, news outlets, media organizations, and just pundits on Twitter and everywhere else blaming Brexit for everything, but in reality, this just isn't really a factor, to be honest. Now, finally, just the last thing that we're going to talk about today is Jamie Dimon and JP Morgan Chase and his failure to get put into place his new compensation plan for himself and the rest of the C-suite executives at JP Morgan. Now, what was going on here? Well, these people are very well paid and they were trying to get a little bit better paid. And so he put together a $200 million pay package for himself and the other very high executives at JP Morgan. And as always happens with JP Morgan, it went to a shareholder vote where actually he was just declined. It was rejected and it's not going to come into force. Now, usually this wouldn't really be a major talking point, but it is today. You might read a lot about it on CNBC or Bloomberg or even normal non-financial outlets as well, because it's become a very heavily politicized issue. News about this pay package came out last week, and news organizations came out saying that it was crass and evil and that it's a reason for inflation and all sorts of other kind of nonsense that you read from journalists with the Wall Street Journal and things like that. Now, the really big problem with this, in my opinion, is the fact that really this has nothing to do with you unless you are an investor at JP Morgan. And here's the big issue. The pay package has been so heavily politicized that actually investors are, in my opinion, being forced to act against their own best interests. This graph here shows previous support for pay packages for JP Morgan C-suite executives in the past compared to where we are today. As you can see, every single time this sort of thing has come to a vote, it's been passed almost unanimously. And when it hasn't been unanimous, it's still been very healthy, a majority. And the reason for this is very simple. Investors recognize the value that these C-suite executives provide to the company, and they want to keep them on board and keep them motivated because they provide more value than they take up with their salaries. This year, though, things changed and only 31% of investors voted in favor of this plan, despite the fact it really wasn't anything special or anything different to the past. Now, in my opinion, this is entirely wrong because JP Morgan is a private company with a mandate to maximize its profit, not to keep the public happy. The simple fact is that if Jamie Dimon is producing $50 million worth of value for the company, which actually really isn't a hard thing to get your mind around when you think about the fact that JP Morgan makes $140 billion in revenue a year. If he can help the company become just 1% more efficient, then he is more than making up for his salary, actually 20 times over. He's also pretty much an institution in and of himself. He's been CEO of JP Morgan Chase for almost 20 years and has led the company to really be the best, the most successful, and the most efficient financial institution in the world, in many people's opinions. The reason we're seeing so much uproar about this is the same reason we're seeing Biden come out fighting, telling everyone that actually it's Jeff Bezos' fault that inflation is high, not his own, and really it's just utter nonsense. Business is getting politicized, as we saw back in 2008 when we entered the great financial crisis, and it will only get worse this time round as we really descend into a recession. Biden and many other politicians, particularly on the left, I hate to say it, are finding themselves under a lot of pressure for their awful policies that have led to huge amounts of inflation. And so they're trying to redirect our blame and our anger towards corporations who they claim are really at fault. The reality is, though, this just isn't true. We shouldn't get it twisted at all. Companies react to market forces. Jamie Dimon, as head of JP Morgan, reacts to market forces. He's worth what he's paid, and he's paid what he's worth. Governments, though, do the complete opposite. They change market forces themselves. They get in the way, they cause crowding out, they cause inefficiencies and bureaucracy, and they ultimately cause inflation, not corporations. Biden is almost entirely to blame here, and I only say almost because actually this problem started back when Trump was in power, because the Republicans are not innocent here either. And we've also seen very similar problems across the rest of the world with the European Central Bank, Lagarde, the president of that bank, Boris Johnson here in the UK, and almost the entire Tory party as well. Really, what we have here are problems that are caused by our governments and our politicians, that the media and those politicians themselves are trying to pass blame on to other people so that they can stay elected for another term. In the UK, the target seems to be big oil companies and placing the blame on them for inflation, despite the fact our inflation is almost entirely self-inflicted. Our politicians and our media and our government, everyone really, no one has the balls to stand up and say, you know what, this inflation is our fault because we decided to stand up against the Russian invasion of Ukraine. People make decisions, and that was a decision we made, but for some reason, our government is incapable of making that leap. Now, that is it for the day. Thank you all for watching. Of course, I'm in a sort of a new studio. Actually, it's the same one as yesterday. I'm just facing the other direction. I'm sat at my desk. Hopefully, that window there isn't too bright. The sun is there. I have got lights coming that are going to go behind the camera over there shortly, but they've not arrived from Amazon yet. There is a big door that I can pull across here, and once I get all this decor and more lights set up, I probably will do that. As it is, though, hopefully this was okay. Hopefully the sound's okay. This is, of course, a new mic as well. Leave any advice, any comments down below in the description as always, and thank you for watching. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help out. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord server and exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. Of course, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists like Banksy. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource if the markets, crypto and stocks falling every week. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get interest on your crypto, so it's earning you money while it sits there. Thank you all for watching. Stay stoic. Until next time.